Hi, everybody. Welcome back to VCTV, and it's the Market Making Insight series. Today is episode 5 of Market Making Insight series with Meenu Sarin, our guest speaker. And today we're going to cover centralized exchanges versus decentralized exchanges. What's the liquidity play in those, and much more coming up. I just want to talk a little bit about what we covered in the first episodes, like the first episode till the fourth episode. We covered about market making. What is market making? We covered about the roles and responsibilities of the market makers. We covered about different markets. We covered liquidity support. We also spoke about efficient markets. We also covered automated market making, how it is used in DEX, impermanent losses, liquid token, liquidity mining, and yield farming. So far, we have covered these topics. And today, on episode 5 of Market Making Insights with Meenu Sarin, we're going to discuss about market making differences in market making between SEX and DEX. So digital asset trading rose to prominence in the past few years. We know about that. We can attribute this rise to the emergence of crypto exchanges all across the globe. As you know, all of us see that crypto exchanges are getting, more and more crypto exchanges are getting launched every single day. So they have made it easy for people to buy, sell, and trade digital assets like cryptocurrencies. Okay, so crypto exchanges have played a primary role in the success and mass adoption of cryptocurrencies. Yet users are still torn between the type of exchange they should use for trading. At present, the two different types of crypto exchanges, centralized and decentralized, have their own advantages and disadvantages. So on this episode of VCTV, we're going to cover differences between DEX and SEX, how market making is done, and what's the benefit of one opposed to other. So let's just bring our guest speaker for the evening today. Hi, Meenu. How are you?
Hi, Sunny.
Good to see you.
Good to see you too, Sunny. Thanks.
So, how are you? How has been the week so far?
Good. It's been going on well. What about yours?
Oh yes. Okay, I'm very good. I'm very good. I'm glad to be hosting and back on this episode of Market Making Insight. Actually, I wanted to introduce my colleague, Fadil Masal, who has just joined Last Token very recently. Hi, Fadil. Can you just introduce yourself?
Hello, everyone. My name is Fadil. I'm from Cyprus, and I'm coming from a finance background. I've worked over 10 years at Reuters in different sections, in different like financial market sections. And then I made dealing in Germany and in Cyprus. And 1 month ago, I joined at La Token with Sony's team.
Glad to have you here, Fadil.
Welcome, Meenu.
All right, thank you, Fadil, for that introduction. So we have Fadil today, who's going to joining the show and asking you a few questions, because obviously we work very closely on the trading desk within La Token. So it's very important for us to gather that knowledge that you have. You can share as much as you could. So specifically on today's topic is very crucial, and we would like to know the differences between SEX and DEX in terms of market making.
Okay, sure. Thanks, Sunny. And I think it's a very good thing that, Fadil, you are here in today's session, because while I go through the various concepts, you with your trading experience, I think it would come in quite useful for the viewers. So yes, let's let it be an interactive thing, so we could just make it bounce to and fro. So today's episode, we are going to talk about the exchanges. And so exchanges are basically, they're the forums where you trade your tokens. And one would say that because blockchains are decentralized, So the trading of the tokens which are there on the blockchain, that should also be decentralized. And then the trading of those tokens happens on the blockchain, right? So that is a pretty fair assumption. But then that is not always the case. So that's what we're going to take a look at right now. Now, in the context of your tokens, you have two kinds of exchanges. One is, as you mentioned earlier, Sunny, one is your centralized exchange, and the other one is your decentralized exchange. So I'll go through each one of them. Let's take the centralized exchange first. So you have the slides,
Yes.
Sunny. Okay, if you could
Yes,
just
I'm
pull it
going to
up.
share my screen.
We can go to the second slide. Though the text is not there, I would be going through that. Yeah, that's okay. That's okay. That's okay. That's okay. Uh,
Okay.
yeah, I'll just go through the thing. Yeah, I know which one to refer to then. Okay. So the first one, as I said, is the centralized exchange. Now, what is a centralized exchange? So, the centralized exchange is like your traditional online brokerage firm or a traditional exchange. So, here you are trusting a central entity with your assets, with your digital assets in this case. You're trusting it to hold your money, to offer security to your assets, and to do your transactions. Overall, it is to offer a kind of a conducive environment for the trading of your tokens. So, whatever is involved in it, the centralized exchange should provide that. Now, having said that, the one good thing about the centralized exchange is the ease of working, ease of trading, ease of interaction, ease of engagement. So, when you want to trade on a centralized exchange, you create an account, which means you have a username and a password, just like you would do for an email account, right? And then you can just start trading. So that it is as simple as that. And if you happen to engage or transact with a fiat currency, that is, you're depositing a fiat or you want to withdraw a fiat, then you will need to go through some verification checks like your KYC, etc. But then that's about it. There's nothing, a lot of things which are complexities which are involved in the working. Then comes something what we call it as a counterparty risk concern. So when you're depositing your assets, your crypto or a fiat into your centralized exchange, you're actually entrusting a centralized entity, the centralized exchange in this particular case, with your funds. So when you do a trade or any transaction, you're actually authorizing that central entity, the centralized exchange in this case, to do those transactions on your behalf. So you're authorizing them. So what happens then here is that because of this authorization to a third party, you do not own the private keys to your funds here. Okay. So what happens because of this, because you're trusting a centralized entity here, there could be some counterparty risk concerns. Okay. Then you have that in a centralized exchange, the orders are not executed, the trades do not execute on a blockchain. And what happens is that the centralized exchange gives all the users, they give some account balances from their own account databases. And what happens with this is because the transactions, the actual trading does not happen on the blockchain, then the trading is not impeded by the speed of the blockchain. And for that very reason, the speed of your transactions, your trading is pretty fast. It's not slow. So there we have the conveniences of the ease of use. You don't need to have a very complex understanding of the trading and the market and so forth. You are entrusting that centralized entity with that. Okay, but then there are some concerns and so forth. And it's a very fast transaction, and that is something which you may want to prefer over the in your transactions. Then you come to the second one, which is your decentralized exchange. Yeah. Now, in the decentralized exchange, your trade is happening directly between the users' wallets. So it is now a peer to peer, or you could say a peer to a smart contract transaction. And here, the user has the private key of his funds. So, as a user, I would have the sole custody of my funds. I am not entrusting my funds or authorizing my funds to any central entity. Now, so it's basically an exchange where your orders get executed on the blockchain. But having said that, I would say that in the decentralized exchanges, they are put into two buckets. One of them is called the order book decentralized exchange, and the other one is called your liquidity pool exchange. Now, the order book decentralized exchange is one in which your order book is central. So it is like your traditional exchanges.
Mhm.
And further within the order book decks, you have two other categories, two flavors. One of them is called on chain, and the other one is called off chain. Decentralized order book, decentralized exchange. So on chain and off chain. So, what is an on chain order book? The on chain order book decentralized exchange is the one which is fully decentralized. Everything happens on the blockchain. So, every transaction, whether it is recording the transaction, altering, cancellation, everything gets recorded onto the blockchain. Okay.
Yeah.
Now, because it is everything is done on the blockchain, one would say it is the most transparent, right? Because it's on the blockchain, everything is on the blockchain. It is the most transparent, but also it is the most impractical. Why is that? The first thing is that this is expensive, because what you're doing is every order cancellation, actual execution, or whatever it is with the order, that is being recorded on each and every node of the blockchain. And it is not just being recorded, it is also being stored for perpetual, because it has to be available over time. So, this recording, this creation and maintaining the storage over a period of time is what makes this particular trade expensive. Okay.
Yeah.
And because each and every node of the blockchain now has to do this, it's involved in this transaction, the actual transaction, the actual transaction, that
Yeah.
becomes very slow, because then that depends upon the speed of the blockchain, and each and every node has to have the recording, and everything is downloaded onto each and every node. So it is expensive, and therefore it is, I would put it as not that practical. So that's your on chain decentralized uh, exchange with the order book.
Mhm.
Now you come to something what is called the off chain order book. Now, the off chain order book is something like a midway. So it has got a partial decentralization. So what happens is here, your trades are actually getting executed on the blockchain. Okay.
Yeah.
But the orders, they are not posted or they are not recorded on the blockchain. That happens off the blockchain. So what happens is that one entity, or let's say multiple entities, they can pool in the thing, the liquidity, and they relay the orders between the users. So this is offline. Okay. And when the parties are matched and the trade has to happen, then that trade happens on the blockchain. So that part of the trading is on the blockchain. The other thing about your uh, the order book stuff is off chain. That's the difference here. So because the this would make the speed a little bit faster than the on-chain order book decks.
Yeah.
But then the thing comes as, because it's a partial decentralization, right?
Yeah.
So how do I check the veracity of, or how do I validate these off-chain calculations? So therefore, the smart contracts, what they do is they would have some special mathematical algorithms, like they could employ zero knowledge proof, for example, to validate, or let's say verify, these off-chain transactions, calculations, and before they are recorded onto the blockchain.
Mhm.
I hope that's clear. Okay.
Yeah, yeah, that's very
Yeah.
clear.
Yeah. So basically, just for the information, the zero knowledge proof that I just referred to right now, it's just basically a technique, a mathematical protocol, or whatever you want to term it as, in which you can verify the veracity of that information without actually knowing or revealing the underlying data.
Hmm.
So I'll give you an example just to demonstrate that. It is, for example, if you have a payment application. Now, in the payment app, let's say you want to check whether you have a payment app wants to check whether I have sufficient balance for a certain thing.
Yeah,
So it can check whether I have that sufficient balance without actually getting to know what is my balance. So
right,
that's why it is called a zero knowledge proof. So
right,
basically, how it helps is that all the sensitive information, transaction, documentation stuff that people, brokers, XYZ, or traders, etc., they would want to do, that can happen in that seamless manner. They make it totally private.
right.
So this is your on-chain and your off-chain order book. So just as a recap, in the on-chain order book DEX, everything happens on the blockchain.
Right,
Most transparent, but also expensive and slow. In the off-chain, sorry, in the off-chain, it's a partial thing. So the order book stuff is done off-chain, and the actual trade gets executed on the chain.
right.
That's the basic stuff. The second category in this DEX, the decentralized exchange, is the liquidity pool DEX.
Yeah,
So if you recollect, liquidity pool is the funds collected together, and you have an equal value
yes,
pair in a
yeah,
liquidity pool. But basically, liquidity pool is a smart contract, and
mhm,
users interact with the smart contracts by into the smart contract by calling functions onto it.
mhm,
So I just repeat that. The pool is actually a smart contract.
yeah,
So there is no human or anybody involved in interacting. The users would interact with the smart contract by calling functions onto the smart contract. Okay.
right,
So in the liquidity pool, how does a trade happen? So suppose somebody wants to, let's say I want to buy something. So I have to sell something of an equal value for that trade to happen.
yeah,
So when I want to do that in a liquidity pool DEX, what I do is whatever token I want to buy, I take
mm,
it out from the pool. And an equal value of that token, I need to put back, which is the other token of the token pair that I'm selling. So the buy and
yes,
sell happens.
mhm,
So that is what a liquidity pool DEX is.
yeah,
Okay.
yeah,
Then we come to the last one, which is what we are talking about, the differences between the centralized exchange and the decentralized exchange. Each of them has their pros and cons.
yeah,
So, for example, in the centralized exchange,
mhm,
we have a centralized exchange typically has high trading volumes, it has got
yeah,
good liquidity, the speed of engagement transactions is high, and it is easy to use. But on the flip side, you have this thing about there is no anonymity there. You have you are what you're doing is that you are trusting a central entity with your funds, so there could be a counterparty risk, and the exchange is controlling your funds. In this case, you do not hold custody of your funds. And the other one, if you talk about the DEX, the decentralized exchange, so the decentralized exchange is offering a greater anonymity for the investors. And in this, as a user, I have the sole custody of my funds. I hold the private key to my funds. I am not giving it to any third party, any centralized entity. On the flip side, it is not so user friendly. I would need to know a lot of things as to how do I work with a decentralized exchange. And typically, I would say that the experienced crypto traders are the guys who actually would be using the decentralized exchange and not your general typical retail traders. So
Yep.
that broadly is the thing between the centralized and the decentralized exchange. And reverting back to what a just brief thing we had with Fadil, sorry, was about the fiat, right? The fiat transaction. So maybe Fadil, if you want to take it up, you can start from here.
Yes, we were talking about if when it comes to fiat to cryptocurrency conversions, which one is better? Is it centralized is better or decentralized is better? But for now, for the current technologies, uh, it's not possible to make the conversion from fiat to cryptocurrency on the decentralized exchanges. So, although you're using a decentralized exchange and you want to go to fiat, then you need to withdraw your cryptocurrencies to a centralized exchange to go out to fiat. So, this is the current limitation. I know there are some studies made on this to overcome this problem. So, in the near future, uh, the conversion from cryptocurrencies to fiat will be possible on decentralized exchanges as well.
Do you think the evolution of the regulation of the tokens, etc., has to do something with how this particular thing will evolve?
Of course, a lot. You know, there are lots of stuff going in SEC in America, Securities Exchange, lots of stuff going in Europe. I know in Turkey, they give permission to few exchanges to operate as crypto to fiat.
Right.
So it's evolving, but definitely they have a part on it.
Yeah, yeah. I guess all that anti-money laundering and stuff would be the concerns and behind whenever you're doing any interaction, engagement with the fiat.
Yes, when it comes to fiat, KYC is very important now.
Yeah,
The governments are asking the exchanges to increase their KYC requirements.
yeah.
So, I mean, I remember like 3, 4 years ago, KYC was very, very easy. You would just write your name, take your picture, and they were accepting you. Now,
Okay.
it's getting more difficult. More, I
So what do
mean,
you do now, Adil, for KYC?
for KYC, you need more stuff now. You need to take a picture of you, like holding your ID in your hand, and you need to provide your address, like lots of more stuff.
Yeah, yeah.
Which is
I,
good.
I, I do recollect one in which it was like the address you need, for example, your utility bill or something like that. You
Yes,
need to put it. Sometimes they have the date has to be there with your photograph, something like that to get all the stuff put into I mean,
yes,
that you
yes.
are the person who you say you are.
So does that mean that people would naturally go to a DEX because it provides more anonymity or not?
My take on that would be people would go, but the thing is that how comfortable you are with the decks, right? If somebody who is not so, what should I say, has so much of a thing as a trader, for example, like me, I would rather, do small bits and pieces with something which is simple. But people who are actually doing quite a bit of their income from this, I guess the anonymity does serve, because blockchain at the end of the day is a lot about, if I can say, not only but a lot about anonymity, right?
Yeah.
So if we are talking about that, and if we take it in a clearly clean legal way, then that is the way it should function. It should be completely decentralized. All my transactions happening in a decentralized way. Nobody should be knowing where I am from. But that's a very utopian thing. So that's, I guess, it's a way of evolving. And I guess what Fidel had earlier also referred to something as in between some hybrid things would come, or they
Yeah.
are coming, and perhaps that's the way it would evolve and how the adoption would take place.
Absolutely. I think you
Yes.
rightly pointed out, Meenu, the differences, the benefits of the centralized exchanges versus the DEX. I mean,
Hmm.
you can be a token owner, but once you want to trade on an exchange and do not know you're not a daily trader or an experienced trader, then obviously you cannot go on a SEX unless you really know how. You have to be hands-on, as you rightly said. But that's why a lot
Hmm.
of projects are moving to centralized exchange, even though we have to do a very strict KYC as but
Hmm.
also we have to have many more data from the user, from the token issuer, the owner, than
Hmm.
we did before. But that's what we are protecting them, right? It's about investor
Then, yeah,
protection.
I think, Sunny, but then there's also a flip side on it, because it's just like you have your data on, I'm talking about not on the tokens, for example, but on any data you have. If
Mhm.
you are trusting a central entity with your data storage, right? Whether you want your data to be with that entity or you would rather have the custody of your data, it depends from a person to person, right?
Yeah,
So I'm not sure whether I would say the cyber attacks or vulnerability is with more with one than with another, but the thing still stands that if I am an experienced trader and I know maybe perhaps how to handle my wallets, X, Y, Z, and so forth,
yeah,
rather than maybe a central entity where which could be vulnerable to attacks. Again, I'm not saying any one is more vulnerable or something, because frankly speaking, I do not have that information, or I'm not aware of it right now.
mhm,
But I would presume that if I'm an experienced trader and I know how to handle the stuff, I would
yeah,
rather have the custody of my own funds, because every
mhm,
morning if I get up and see, hey, this thing has got hacked and I don't know and I can't trade any further till the measures have been put in. That's that's not going to work for me if I am one of those experienced and very hyperactive hyper trader in that sense. So
yeah.
I don't know. That's my take on that.
So I think when it comes to security, the centralized exchanges are equally, very much concerned about this because we are controlling the funds of both the token issuers and the traders who invest into these tokens against the pair they're traded against. So I think security, privacy is a key on a centralized
Yeah.
exchange. This is coming from the fact because I work and I see the KYC process every day. It's very stringent to protect both sides.
Yeah, no, that's absolutely right. Correct, I would say, Sunny. And also, let's say if I am one of the user, I
Yeah.
would be vetting my exchanges before I actually go for a trade. I would be vetting my centralized exchange, for example, to figure out which one of them offers what kind of a security, right? So that
Right.
is what would differentiate one centralized exchange from another, apart from the other factors like
Yeah.
liquidity and
Yeah.
spread and stuff like that.
Yeah.
But yeah, I need my assets to be secure. So yes,
Absolutely.
the need is evolving, but we see how it goes further.
Very interesting time. Fadil, any questions or any insights you would like to share from your experience working with
Many,
Lapsec?
I have a question. What are the differences regarding market making on decentralized exchanges and centralized exchanges?
Okay, I had covered this earlier, Fadil, but in a very snapshot, I would say that in your centralized exchanges, the market making is done by simultaneously coding orders, the buy and sell. So you are giving, what should I say, the a depth onto the order book and liquidity, and you're spurring the trading of the tokens, adding to the liquidity into the exchange. That's by
Mhm.
putting tokens. Whereas in your DEX, you're usually talking about a liquidity pool. So in that liquidity pool, you have your automated market makers who are working on that. Uh, I'm not getting into the whole thing because that's
Yeah,
something which we had already covered in the earlier episodes.
I
But
totally get that.
you are not
Yes.
placing any additional orders and trade and sell there in the automated
Yes.
market.
So what I understand from is on DAX, things are more faster, more efficient.
I would not say it is faster. Because if you recollect, when I said about the on-chain order book, where everything is happening on the blockchain, then the trade speed, the transaction speed is factored by the blockchain speed. So that's not going to be fast. In
Yes,
terms of
correct.
the speed, generally speaking, the centralized one is faster.
So it depends
So
on your blockchain speed.
exactly. Because how many nodes are there on the blockchain? Each and every one is going to record it. If I'm talking about the on-chain order book. In a liquidity pool, it is a little bit different, of course, and the off-chain is also different because you're doing your order book calculations elsewhere. Only the trade is happening on the blockchain.
Yeah.
Right.
Okay, thank
Okay.
you.
Thank you, Dale, for that question. And thank you, Meenu, again for episode 5. We're going to be having more episodes coming up about market making insights. We had a great time. I hope so. We were discussing about DEX and SEX exchanges and obviously crypto exchanges. I see every day new exchange coming up and centralized exchanges moving into decentralized space as well and vice versa, you know.
Yeah.
So future looks very, very bright, I would say, and positive. And so I'm very excited, and we'll see you next week and on another topic, another episode. May we know what topic we'll discuss next Thursday?
I'm not too sure about it because I still have to work on that.
No worries.
But further down the road, I had in mind, I don't know when and in which episode, I wanted to get on to the token price.
Ah,
So,
yeah,
what determines the token price
yeah,
and a few factors by which you can address the velocity part of the velocity problem in the money equation.
right.
So, it's
Amazing.
more on the token price. Yeah.
Very, very relevant topic. I think we have Fadil, we see a lot of questions coming from clients on the price as well, token price. So I think that's going to be very key and relevant as well for our community.
Yeah. Thank you. And let's see
All
how it
right,
pans out.
absolutely, it's going to be great as usual.
Thank
So thank
you.
you, Meenu, for your time today. So we'll be back again next Thursday, this time Singapore time, 5:30 p.m. Singapore time, viewers. So till then, stay tuned. But I am coming back again in 1 hour on VCTV to discuss another fantastic topic. It's about investments in emerging markets. So please do watch and take care of yourself. And goodbye, and see you soon. Bye.
Thank you, Sunny. Thank you, Fadil, and the
Thank you,
viewers.
Manny.
Thanks for tuning in. Cheers.
Bye.
Bye bye.
See you.